Hello, if you clicked on this video, I assume you're a trader. And as a trader, the first thing that you need to master isn't an indicator or something else. It's just your watch list. But most people's watch lists are just a disaster. It's an overcrowded list of stocks and like a crypto coin they heard on Reddit, or just a few big names like Apple or Tesla. And if that's you, you're not really watching the markets, you're just watching noise. I've been trading for 5 years, and I've realized that if you focus on a small number of items in your watch list, that each item represents a sector in the market, it will be much faster and easier to realize the status of the markets. And in this video, I'm suggesting 10 ETFs that would act as essential items in your watch list. Now, there is a philosophy behind this approach. I've only chosen ETFs because each ETF is a basket of thematically related stocks or commodities. So basically, by monitoring just these 10 tickers or 10 ETFs, it's like you're effectively watching thousands of assets simultaneously. The trading time frame that works best with this watch list is swing trading. So we have three major approaches to trading. The first one is day trading, which is like a full-time job. The second one is long-term investment, which basically the horizon is 10 years or even 20 years. But the third one is swing trading, which you open positions that might last weeks or months. So you want to catch the medium-term swings of the market. Trend following is basically the art of buying high and selling higher. We can never predict the price of assets in the future, but there's one thing certain in the financial markets, and that is asset prices trend. And we want to ride on these trends until these trends die, and then we find another sector of the market that is trending. And this is how market rotation and trend following go hand in hand to help us with our swing trading. So the first ETF that I want to talk about is RSP. The Invesco S&P 500 equal weighted ETF. You know about S&P 500, which is the main index in United States economy. It's basically a gauge, shows how the stock market in the US is doing. The problem with S&P is that it's heavily weighted by just a few massive companies. But RSP is different. It gives every single company in the S&P 500 an equal vote. So sometimes the S&P 500 might be green, but it might be only a handful of stocks, like giant tech stocks. Sometimes we call them Magnificent Seven stocks like Netflix, Facebook, Amazon, and other stocks that are carrying the weight of that market. When RSP is green and is trending upwards, that's what I want to see as a swing trader, because it shows that the breadth is healthy in the market and there's opportunities everywhere. So I think it's a good habit to, instead of looking at Dow Jones, S&P 500 or NASDAQ, just look at RSP, and it tells you if there's a positive outlook in the United States stock market or not. The next ETF is XLK, which is the SPDR Technology Sector ETF. This is the home of giants like Microsoft, Apple, Nvidia, and a few other massive technology companies. In the past few years, in the past decade, we can tell that the tech sector, the technology sector, has been the engine of the market. So when the XLK is green, but RSP is not like as positive as XLK, it means that the technology sector is going up, but the broader market is not following that much. So maybe that's when you want to be only in technology and forget about the rest of the market. So as you see, we start our day by looking at RSP as the broad market, and then we go specifically into different sectors, starting with technology. The next ETF is IWM, iShares Russell 2000 ETF. Russell 2000 is an index that tracks 2,000 small cap American companies. So basically, after we check the giants, then we go and check the small ones. And think of these as the Main Street businesses as opposed to Wall Street businesses like Apple or Microsoft. These are companies that don't have billions in cash. They are basically highly sensitive to interest rates and the local US economies. The IWM is the gauge to see how offensive you should be in your trading. Basically, when IWM is trending upwards, it means that market is in risk on mode. So it's time to take risk and go all in. This is a good ETF to find explosive swings. Because these stocks are smaller, they usually move faster. And if you can become experienced and thoughtful enough to trade smaller cap companies or ETFs, then you can capture much bigger and faster moves and make more money in shorter time. The next ETF is VTV, which is Vanguard Value ETF. So this is quite opposite to the last two ETFs that we discussed, and that's the good thing about this watch list. that each item is kind of unrelated to the other items and represents a different sector of the market. Value stocks are contrary to growth stocks like the technology stocks that we talked about. These basically represent the boring side of the market. This value ETF is a basket of a large number of different sectors, basically like financials, healthcare, and industrials. VTV can act as a great safety sensor and show the rotation in the stock market. For example, when XLK technology and IWM small caps are red, you might think that the market is crashing. But if you check VTV, it might be green or stable, which shows that the market is not crashing. It's just a rotation from offensive part of the market into the defensive. This shows you opportunities to get out of growth and risk on and maybe catch trends in the boring part of the markets or the value stock. The next ETF is XLE, which is the energy sector SPDR ETF. As you might think, this ETF represents the oil and gas industry. But in this day and age, in 2026, it's not only oil and gas, because AI data centers are hungry for energy. If our demand for AI is growing, it will also raise the demand for energy. This is another completely unrelated sector from the previous ones. Historically, when tech stocks, like in XLK, they take a hit because rising costs or inflation, XLE is the one sector that stays green, so it might act as a hedge as well. And it's also representative of the price of oil and gas, so it's like trading in commodities. The next ETF is XME, which is the metals and mining ETF, only the American metals and mining. So this ETF basically is all about metals. There are many ETFs that track miners and basically metals, but I've chosen this one deliberately because this one is a mix of all basically metals used in industry. Includes precious metals and basically raw materials like steel, aluminum, and copper. Looking at one ETF called XME, you can have a gauge of how the metals are doing as a commodity. In the last 6 months, precious metals and metals in general, even copper and platinum and aluminum and uranium, they've all have outperformed all other assets basically in this financial market. If XME is trending, it shows that the number of precious or non-precious metals are trending, and then you go into details and trade, for example, copper or silver or so forth and so on. The next ETF is VEA, which is Vanguard Developed Markets ETF. So now it's the time to look out of United States. VEE tracks the developed world, which is major economies like Japan, the UK, Europe, or Canada. So I watch VEA to see if the capital is staying in the United States or is flowing into safer established international markets. Stocks in the UK or in Japan or in Europe in general are much cheaper based on their valuations than the stocks in the United States that have been in a huge bull market for the last 10 years. And at the time of recording this video in early 2026, everyone is talking about developed and developing markets breaking out, which is a good time to talk about my next ETF, EEM, iShares Emerging Markets ETF. So VEA showed us how the developed world outside of United States was performing, but EEM is about the high-growing emerging giants like China, India, Taiwan, or Brazil. And a pro tip is that EEM, the emerging markets, they have an inverse relationship to US dollar. So when US dollar is in a bear market like we currently are, you can expect EEM to grow exponentially. The second last ETF is ARTY, which is the Future AI and Tech ETF. So we had XLK before, which is about the established technology companies, but I've included this one, which is all about future. So it's about small cap technology companies, which could be generative AI software or specialized data infrastructure companies. As I told you, technology is the backbone of the market, but this ETF will tell us money is flowing into the established name, or now investors are taking more risk and they're investing in smaller technology companies, which shows that they're really positive and optimistic about the future of technology in general. The last ETF has a similar vibe, but in a different sector. It is ICLN, which is iShares Global Clean Energy ETF. So this is a very broad and international ETF that tracks the companies that provide clean energy globally. And this is a theme that we know that kind of definitely many countries are going towards, and just to reduce the reliance on fossil fuel. And it's interesting that in our watch list we had XLE, which is fossil fuels and old types of energies. But this is all about the future and type of green energies that we might utilize more in future. We know that AI data centers, they not only use electricity generated by fossil fuels, they use any type of electricity that they can, including nuclear or solar. Usually, if this one and the previous ETF are going up, it means that the market is in full risk on mode and it's about investing into the future. And that was my recommended watch list for you today with only 10 items. I hope you found this video helpful, and at least some of these ETFs will find their way into your watch list and help you trade better and understand the market better. If you have any suggestions for my watch list, please leave it as a comment down below. And thanks for watching this video, and have a great day.